When I first heard about Fibonacci, it sounded advanced, like some secret math only pros used. I pictured complicated math and secret trader rituals. Then I tried it and realized it's actually simple. You measure a move, mark a few percentages and watch how price reacts. No magic, just logic, crowd psychology and a few useful levels. Today, we'll break it down step by step what it is, how it works and when it actually matters. Hi, my name is Matthew and this is Focus Charts. But before we jump into charts, let's go back for a second. Leonardo Pisano, called Fibonacci, was an Italian mathematician from the 13th century, born around the year 1170. He's most famous for discovering a simple pattern of numbers, what we now call the Fibonacci sequence. He actually came up with it while studying how rabbits reproduce. He imagined a pair of rabbits that produced another pair each month, and from that he realized that each new number in the sequence is the sum of the two before it. 1, 1, 2, 3, 5, 8, 13, 21 and so on. When you divide one number by the next, you get ratios that repeat everywhere, in nature, art, architecture and eventually in financial markets too. So when traders talk about Fibonacci retracement, they are basically borrowing this math to measure how far price might pull back before continuing the trend. Alright, enough history, let's bring it back to the charts. What exactly is Fibonacci retracement and how you can actually use it in trading? In simple terms, Fibonacci retracement is a tool that helps you measure how deep a pullback could go during a trend. To draw it, you simply take the most recent move from a swing low to a swing high if the market's moving up, or from a swing high to a swing low if it's moving down. If terms like swing high and swing low don't sound familiar yet, don't worry, they're part of something called market structure, which I'll cover in upcoming videos here on the channel. For now, just think of them as the most obvious turning points on the chart, the points where the trend clearly changes direction. When you draw Fibonacci, make sure you're measuring from the wick, not just the candle body. The wick shows the full range of that move, the highest and lowest price the market actually reached. Once you do that, the tool automatically plots a few key levels: 0.236, 0.382, 0.5, 0.618 and 0.786. These levels are nothing more than percentages of the measured price move, so we can think of them as 23.6%, 38.2%, 50% and so on. They mark potential areas where price could pause or reverse. Think of them as checkpoints within a correction, points where traders might take profits or where new traders might step in. The most watched zones are 0.382 and 0.618, which we call golden pocket. Those two levels often align with previous structure, places where price reacted before, and that overlap is what we call confluence. When multiple things line up in the same area, like a Fibonacci level, a previous high or a trend line, that area becomes more interesting. It doesn't guarantee anything, but it increases the probability of a reaction. And that's really the key point. Fibonacci retracement doesn't predict the future, it just helps you identify potential reaction zones, areas where other traders might make decisions. So when you draw it, don't expect price to stop exactly at 0.618 or 0.382. It's not about exact numbers, it's about areas. Markets aren't that precise, and that's completely fine. So now that you know what these levels represent, let's talk about how to actually use them in trading. The most common use is during a trending market, when price makes a strong move and then starts pulling back. Traders use Fibonacci retracement to estimate where that pullback might end before the trend continues. In an uptrend, you draw it from the swing low to the swing high. You then look for price to pull back into one of the key areas and then wait for a reaction. In a downtrend, it's the opposite. You draw it from the swing high to the swing low and look for potential reactions as price pulls back upward into those same levels. But it's not simple like this. this. Fibonacci alone isn't a trading signal, it's a context tool. It gives you an idea of where to pay attention. The confirmation still comes from other factors like market structure, volume, confluence with some key level, and so on. When you combine Fibonacci with those elements, that's where it starts to make sense, because you're not just reacting to a number, you're reading the market behavior around that level. So don't read these levels as exact lines that price must respect. They are just visual guides that help you stay objective, instead of guessing where the market should turn. Alright, let's look at a real example. Here we can see a clear uptrend, higher highs and higher lows. I'll grab the Fibonacci tool and draw it from the swing low, here at the bottom of this move, up to the swing high right here. Now I'll wait for price to pull back into one of these key zones, usually around the 0.618 level. That's where I often expect to see at least some kind of reaction. That's a great example of what Fibonacci reaction looks like, not because of magic, but because of a lot of traders watch this area and start buying when price hits it. And again, it's not about predicting the exact reversal, it's about being aware of where reactions are more likely to happen, so you can plan your entries, stops or targets with a bit more structure. So as you can see, Fibonacci retracement can be a really useful tool, not because it predicts the future, but because it helps you identify potential reaction zones, areas where other traders might take action. But here's the truth, Fibonacci isn't perfect. Sometimes price respects it beautifully, and sometimes it just cuts right through it, like it's not even there. That's why you never use it alone. When multiple factors line up, that's when it starts to make sense. So if you're new to Fibonacci, use it as a framework, not a forecast. Let it guide your attention, not your decisions. If you found this video helpful, leave a like, hit that subscribe button, and let me know in the comments if you are using Fibonacci in your trading, or if this was your first time hearing about it. Thanks for watching and stay focused on charts.